Good afternoon. My name's Courtney Coyle. I'm chair of the economics department here at Wellesley College. It's my great pleasure to welcome you to the department's 31st annual Goldman Lecture. Before introducing our distinguished speaker, I'd like to say a few words about Marshall Goldman, for whom this lecture is named. Marshall was a professor in the economics department here at Wellesley for over 40 years, from 1958 until his retirement in 2002. Marshall was a prolific scholar and a prominent public intellectual focused on Soviet and Russian economics and politics. Over the course of his career, he authored more than a dozen books, met with Russian leaders Mikhail Gorbachev and Vladimir Putin, and advised several US presidents. His insights are as relevant today as ever, especially in light of the dramatic events and ongoing war going on in Ukraine. Marshall was also, however, a dedicated teacher and a strong advocate for his students, launching many Wellesley FEMs, or former economics majors, into careers in business, government, and academia. So on behalf of the economics department, I really want to extend my deepest thanks to Professor Goldman and the entire Goldman family for their support of this lecture series and also the Marshall I. Goldman Professorship. Now, it's my great honor to introduce this year's Goldman speaker, who is Dr. Susan M. Collins. Dr. Collins is president and CEO of the Federal Reserve Bank of Boston. In that role, Dr. Collins serves on the Federal Open Market Committee, which sets U.S. monetary policy. She also oversees all of the bank's activities, from economic research and analysis, to banking supervision, to community economic development activities, and many other initiatives. Dr. Collins is an international macroeconomist whose widely cited academic papers touch on such topics as economic growth in East Asia and India and capital inflows to developing countries. Before assuming her current role, Dr. Collins was the provost at the University of Michigan, serving as the chief academic officer and chief budget officer for a system with 50,000 students. And as well at University of Michigan, she was also the dean of the Public Policy School and a professor of economics and public policy. But maybe of special interest to us here, she spent 16 years of her career living in Massachusetts. Early in her career, she was an undergraduate student at Harvard, economics PhD student at MIT, and then an assistant and associate professor at Harvard. When she moved back to Massachusetts last summer to take the presidency of the Boston Fed, she became the first Black woman to lead a Federal Reserve Bank. And she noted in a television interview that ran this past summer that that was truly a huge privilege and responsibility. Here at Wellesley, we have a proud tradition of helping women to break barriers, so I hope that a trailblazer like President Collins will feel right at home. In terms of how today's event is going to work, President Collins will speak to us for about 45 minutes, and then we'll have approximately 10 minutes of Q&A. Would you all please join me in offering a very warm welcome to President Susan Collins.
Good afternoon, everyone. Just absolutely delighted to be here. And Courtney, thank you so much for that really kind introduction. So I'm just delighted to be here with all of you today, and here on Wellesley campus in particular. With students, with faculty, it was wonderful to be able to meet with some students earlier and hear a bit about the work that they're doing. And also I know that there's some community members here too, so truly a pleasure. But before I launch into my remarks, there are a few people that I just wanted to take the time to acknowledge. First, the late Marshall Goldman. His legacy of insightful inquiry is very rightfully commemorated by this annual lecture, which is a lecture I've known of for a long time and was really honored to be invited to speak as part of it. I'd also like to acknowledge the Wellesley Economics Department more generally, and in particular your chair, Courtney Coyle, both for the invitation to deliver the lecture this year, but also because over the years, I've personally enjoyed so many very substantive connections with members of the Wellesley faculty, and I know that there also have been and continue to be many wonderful connections between Wellesley and the Boston Fed and more generally the Federal Reserve System, and it's just a delight to be able to really acknowledge that. It's also wonderful to see the Wellesley Economics Department's commitment to excellence, curiosity, and in particular students. And I know that is true of the Wellesley campus more generally. And so I just really commend Wellesley for the fabulous work to send such thoughtful, prepared, and really able women into the world to do very impactful things in so many areas, and that certainly includes economics and finance. I'd also, last but not least, want to acknowledge Wellesley's president, Paula Johnson, and thank her for her leadership, and then on a personal level for friendship as well. She and I and my husband, Don Vereen, as well, who will be here and joining us, got to know each other as undergraduates. It was a few years ago and a few miles away. Yeah, we don't have to date ourselves. But I do have to say it has just been fabulous to see her many distinguished contributions over the years through a remarkable career in medicine, public health, and higher education. So thank you for that. So today, I'm really pleased to be able to speak with you about my role and about the Fed's responsibilities in making policy. And in particular, I'm going to focus on making policy in the midst of uncertainty and on the different phases that monetary policy has taken during the pandemic. I'm going to start with just a bit of context about the Fed's policymaking and other roles, and then I'll turn to monetary policy and explore the important role that uncertainty has played throughout the recent pandemic and ongoing economic recovery. And I want to discuss a bit about how the economy has evolved over this period and talk about policy phases in that context. And then I'll just briefly conclude with some thoughts about connections with my career and also with economics. So, of course, before I begin, I do have to give my standard disclaimer, and that is that these comments are my own. I'm not speaking for any other Fed policymaker, and so this may or may not reflect their views. So let me begin with just a bit of context. The Fed was created nearly 110 years ago, and refined over time, the Fed's duties support the functioning of the U.S. economy really in the public interest. It's an organization with a public mission. For me and my colleagues at the Boston Fed, I see the overarching vision as a vibrant economy that works for everyone, not just an economy that works for some people. And I see our mission as serving the public in New England and in the nation by promoting a strong, resilient, and inclusive economy and financial system. So monetary policy is actually just one of the many ways that we do that. I'm not going to have time to discuss them today, but I do want to at least list a number of the other things beyond monetary policy that the Federal Reserve has in its portfolio. We support the safety and soundness of the nation's financial institutions by supervising some of the country's banks and serving as a lender of last resort to the financial system. We work to mitigate financial stability risks. We support safe and reliable payments and settlement systems. And you can actually think about that as like the back-end infrastructure and services to the banking system and the U.S. Treasury. And that ranges everything from circulation of coins and currency to a variety of different electronic channels. We also promote community economic development in a variety of ways, often working directly with community partners throughout our New England district. And we also do a lot of research, something that's dear to my heart and I think to many in the audience. In fact, with the many economists, students, economic students, and faculty who are here, I do want to say just a bit more about that. Our economists, working with research assistants and analysts, work on a wide range of topics. It's nonpartisan, policy relevant, often data-driven, and, at least in my view, extremely interesting. So I just want to mention two recent examples. A team of our researchers has studied the attention, or actually inattention, that consumers give to inflation, demonstrating that the absolute level of inflation is really important. When inflation is low and stable, consumers really don't think much about it. But when inflation is higher, consumers are much more aware of it, and that makes them more likely to change their behavior. And that's work that's of particular relevance today. Another recent study looked at the potential causes of racial wealth gaps. The authors find that inheritances and other types of wealth transfers from one generation to the next actually play only a small part. The main contributors to the gap are differences in lifetime earnings and pension assets. And their work highlights the role that policies which successfully increase human capital, and so the work of institutions like this one, can play in helping to reduce those disparities. So now let me turn to monetary policy and the core of my talk today. And it's important to note at the outset that at the Fed, we're charged with monetary policy, not fiscal policy. And this involves actions that ultimately affect the cost of borrowing for businesses and households. So we're not involved in taxation and government spending. The Fed spends a lot of time analyzing economic conditions, using data, doing research, listening to stakeholders locally and nationally. And that background work with our experts is a key part of how I prepare for making policy decisions. And 8 times a year, I join the other 11 regional reserve bank presidents and the 7 members of the Board of Governors in Washington, D.C. to discuss appropriate policy decisions. Our meetings include presentations by staff analysts and multiple go-rounds by the committee participants expressing their range of views. So there's substantive discussion before the current voting members vote on policy actions. And the committee's decision and summary of appropriate policies then released in a public statement. And the Fed chair holds a press conference to explain the committee's decisions, and then they're implemented in the market. We actually next meet at the end of this month. I often get asked about, so what actually happens at a meeting? And so saying just a bit about that seemed like a nice way to set the stage. The Fed's policy decisions are intended to achieve the dual mandate that Congress has charged us with: price stability and maximum employment. We currently define price stability as 2% inflation, and it's a low level where consumers and businesses don't see eroding purchasing power as a pressing concern. That goes back to that issue of attention in the research I mentioned before. Maximum employment, which is the second pillar of our dual mandate, is a bit less specifically defined, but it really refers to the broad, inclusive goal of job opportunities for all Americans. And I think it's important to note that while they're often characterized as competing, history has shown that price stability is essential for a well-functioning economy, and it's actually an important precondition for maximum employment that is sustainable. I'm going to refer to a number of charts in my talk, and here's the first one. So the left panel of Figure 1 shows the evolution of inflation since the 1960s, and the gray bars in the chart indicate recessions. While there are many measures of inflation, the one I'm focusing on here is called core PCE inflation. This is the 12-month change in the price of personal consumption expenditures, excluding the important but volatile food and energy components. And the reason to focus on that one is because overall it's a good predictor of inflation's path. As the figure shows, achieving price stability hasn't always been an easy task. An inflationary buildup started in the mid-1960s and persisted until the disinflation achieved under Fed Chair Paul Volcker in the early 1980s. This was followed by an extended period of moderation, with inflation typically near or below 2% since the 2008 financial crisis and Great Recession, lasting until the recent pandemic-related inflation flare-up. Figure 1's right panel shows the unemployment rate along with inflation, further illustrating challenges that monetary policymakers face in trying to stabilize economic activity at a level that's consistent with both aspects of the dual mandate. By raising or lowering interest rates, monetary policy affects aggregate demand in the economy, and Figure 2 shows how the stance of policy has evolved over time. Policy tightening, which is an increase in the Fed's policy rate, the federal funds rate, raises the cost of borrowing for firms and households with the effect of slowing demand for capital, labor, goods, and services, and that in turn relieves price pressure and tends to temper inflation. Conversely, lowering the federal funds rate or easing policy reduces the cost of borrowing, supporting an expansion of aggregate demand and employment, and that tends to increase price pressures, raising inflation. Importantly, many of the deviations of inflation and unemployment from levels that are consistent with price stability and full employment have resulted from unanticipated events that have required the Fed to react. And COVID-19, the pandemic, is a prime example of that, a shock that originated outside of the economic system and resulted in a substantial disruption to the economy, requiring the Fed to respond in pursuit of its dual mandate. So I want to offer some reflections on conducting monetary policy during a period of really heightened uncertainty stemming from the unprecedented nature of the COVID-19 pandemic. I should note that while I was certainly a keen observer of monetary policy for many years, I was not involved in policy decisions until I became Fed president, Boston Fed president, in July of 2022. And a key takeaway for me is going to be that the elevated uncertainty and the risk management considerations that are associated with that uncertainty have played a very important role in policy setting since the pandemic began. And the most salient types of uncertainty have actually shifted with somewhat different policy implications as the situation evolved, and that's what I'd like to explore with you today. Of course, with the benefit of hindsight, some may argue that different policy decisions would have been preferable. However, I think it's too soon to judge how well the Fed has managed the challenges of stabilizing the economy during this very complex period. And we're going to have a lot to learn from the in-depth analyses that this period warrants, and I'm sure that many Wellesley students and faculty will be part of doing those analyses. And much is also going to depend on whether inflation returns to target in a reasonable amount of time with only modest effects on employment. I do want to highlight that I remain what I call a realistic optimist based on my own assessment of current available information. What I mean by that is that the ongoing resilience that I see in the economy and the progress that we've made so far on bringing inflation down lead me to believe that there is a pathway to achieve this desirable outcome. And in fact, that pathway seems to have widened recently, but considerable risks remain, and that's the realist part. Former Fed Chairman Alan Greenspan once noted that uncertainty is not just a pervasive feature of the monetary policy landscape, it's actually the defining characteristic of that landscape. And so I'd like to highlight three main forms of uncertainty that monetary policymakers confront. The first is uncertainty related to data and measurement. And this refers to how accurately the available statistical data describe the variables that they're intended to measure, and to the fact that some variables are not directly observable. Examples of that include maximum sustainable employment, and also the underlying neutral interest rate, the interest rate above which policy becomes restrictive or below which it would become more accommodative. These are both important economic concepts, and they're certainly affected by uncertainty. The second form is uncertainty that relates to the relationships between key economic variables and that influence policy decisions. And examples of this in the current context would include links between a tight labor market and inflation dynamics, and also the size and timing of the effects of monetary policy on the economy. And that's often known as the proverbial long and variable lags of monetary policy that people talk about. The third form is uncertainty that's related to unforeseen events, such as natural disasters, geopolitical developments, and a pandemic. So while statistical methods can use past experiences to help quantify the first two types of uncertainty, these unforeseen shocks really resist prediction. So for policymaking, the appropriate response to increased uncertainty depends on its type as well as the context. And in many situations, uncertainty calls for a gradual, cautious approach to policy. This can arise in periods of increased uncertainty about the data or about the effects of policy actions on the economy. Allowing time for the signal to emerge from the noise in the data or to fully assess the economy's response to past policy actions can lead to more informed policy decisions and to better balancing the risks of doing too much versus not doing enough. But in some circumstances, uncertainty actually calls for policy to move aggressively. And examples there often involve contexts where doing nothing or moving too slowly exacerbate the economic circumstances that policymakers are trying to address. For instance, too small or too slow actions to make monetary policy more accommodative at the outset of a major crisis could lead to a severe labor market set of displacements that persistently lower employment with significant pain for many people. On the flip side, when the risks of higher inflation expectations becoming entrenched, A gradual inflation-fighting approach may limit policymakers' ability to restore price stability without a significant downturn. And so, again, the different contexts and types may call for being gradual in some contexts and being aggressive in others. The COVID-19 pandemic was uncharted territory along all three dimensions of uncertainty due to the size and the speed of the economic disruptions that it induced. And figure 3, just as a reminder, I mean, we lived through so much of those data. Figure 3 plots the severity of the pandemic in terms of hospitalizations and deaths. This unforeseen public health event quickly moved the world to an economic situation unlike any in post-World War II period, with policymakers trying to decipher whether the usual rules governing the behavior of the economy still applied. The pandemic also affected segments of the economy very unevenly and in non-standard ways relative to previous economic crises, making it more difficult to interpret incoming data and assess the effects of monetary policy on the economy. And as time passed and the economy evolved, so did the nature of the pandemic-induced uncertainty, and nuances in how uncertainty influences policy decisions contributed to distinct phases of monetary policy, and I'll discuss that now. To set the stage, I think it's helpful just to highlight a couple of key features of the economy pre-pandemic, so before early 2020. Overall, in early 2020, and this was in the earlier figure 1, the economy was doing quite well. Despite an unemployment rate that had fallen to near 50-year lows, core inflation actually remained below the Fed's 2% target. And there were no clear indications of inflationary pressures. The Fed was not actively involved in restricting economic growth. And importantly, this monetary policy strategy of letting the labor market run hot, with inflation still below target, was successfully drawing more people into the labor market, benefiting people of color, those with less education, groups that have traditionally endured above average unemployment rates, and it fostered a broader-based and more inclusive notion of maximum employment. In March 2020, the COVID-19 pandemic struck, and almost overnight, much of the US and global economy shut down. Economic activity plummeted, and by April 2020, the unemployment rate had spiked to 14.7%, an extraordinary jump in speed and magnitude. In addition to the enormous public health uncertainty, the COVID-19 shock created unprecedented uncertainty about the extent and the length of the economic shutdown. It was really unclear how consumers and firms would react to social distancing, to limits on mobility, and more. And there were also concerns about an extended period of depressed economic activity, bringing the possibility of falling prices, potentially resulting in a deflationary spiral. And there were worries about very high unemployment, leaving a more permanent labor market imprint, despite the hope that many of the layoffs would be temporary. And the pandemic also laid bare and exacerbated labor market inequalities, as lower paid customer-facing occupations were affected the most by the shutdowns, while many of the higher paid occupations could be performed remotely. The left panel of figure 4 shows disparities in unemployment by race, and the right panel shows disparities by educational attainment. There's much more to say about these and other disparities than I have time today, but I did want to highlight that point. Separately, closures of schools and daycare forced some individuals, especially women, who could not work from home to drop out of the labor force, at least temporarily. So the situation involved considerable uncertainty about the possible extent of the economic damage brought on by the pandemic and the potential for significant negative feedback loops. This called for large and decisive monetary and fiscal policy actions to avoid a worst-case scenario. The Fed cut its policy rate to essentially zero and provided forward guidance on the future path of interest rates, indicating that rates would remain near zero until particular improved economic conditions were achieved. The Fed also launched an array of programs to support the flow of credit to businesses, households, and state and local governments. And the Fed gathered additional sources of information as well in an effort to reduce uncertainty and better understand the extremely unusual economic conditions. Elected officials provided extraordinary fiscal assistance to the economy, and its effects are still reverberating. For example, figure 5 captures the extent of the support to households. It shows the large rise in disposable income above pre-pandemic trends, and that rise was much larger than the increase from fiscal actions in previous downturns. The timeliness and magnitude of these fiscal and monetary policy measures ultimately succeeded in preventing the most feared economic risks from materializing. The unemployment rate dropped rapidly, and there was little decline in inflation from its low pre-pandemic level. Of course, containing the virus and the swift development of vaccines were crucial to avoiding a broader crisis. After the acute phase of the pandemic, Figure 6 shows that there was a noticeable rebound in GDP and its larger component, personal consumption expenditures, in the second half of 2020. Both of the series are plotted in this chart relative to an estimate of long-term trend. But despite this progress, many were worried heading into 2021 that economic activity could stall. The real-world effectiveness of vaccines, which had just become available in December of 2020, was still uncertain, and another wave of the virus was underway. And so the extent to which consumers would be willing to resume normal activities was quite unclear. Amidst this background of continued high uncertainty, monetary policy remained highly accommodative with rates near zero, even as inflation started to pick up, as is shown by the lighter line in Figure 7. At the time, the rise in inflation was believed to be mainly tied to supply chain constraints that would resolve quickly. Expectations of future price increases remained low, reinforcing the idea that inflation could rise temporarily without leaving a persistent imprint on the economy. And although the unemployment rate had improved considerably, it was still around 6% in the first half of 2021. That's above levels considered consistent with full employment. This state of affairs did not suggest an immediate need to remove monetary policy accommodation and tighten financial conditions. In such a context of higher uncertainty, it's crucial to assess the costs associated with each risk to the economic outlook and devise the best strategy to achieve the Fed's dual-mandated goals. And in the early stages of the pandemic recovery, given the still uncertain public health situation, risks of demand setbacks outweighed the risks of inflation. With the benefit of hindsight, one could argue for removing policy accommodations sooner. But to me at the time, given the continued significant uncertainty, it seemed prudent for the Fed to support the economy instead of preempting an inflationary surge that few were forecasting. Ultimately, the economy evolved quite differently than anticipated, and in particular, demand exceeded expectations while supply fell short, resulting in a large demand-supply gap that fueled inflation. Figure 6, which I showed before, showed that by early 2021, GDP and consumption were already above trend, and subsequent waves of the virus did little to slow demand, which was unusually tilted towards consumption of goods and away from services. However, the supply chain constraints persisted, and Figure 8 shows one measure. This is the New York Fed's Global Supply Chain Pressure Index. And while efforts were underway to understand the supply bottlenecks, including developments of new indicators such as this one, it proved really difficult to assess the extent and duration of supply challenges from an atypical pandemic shock in real time. And Russia's war in Ukraine, starting in early 2022, was yet another unanticipated event, adding to supply chain pressures and firms' costs. Importantly, many also expected that as the economy reopened more fully, spending would shift from goods, which people could consume while sheltering at home, back to services, and that would ease price pressure for goods. And given the expectation that supply in the services sector could meet demand sufficiently, service sector inflation was not expected to rise significantly. But here, too, reality was different. Households had accumulated substantial savings during the early stages of the pandemic, thanks to the fiscal support and limited opportunities to spend. So services consumption did rise, but without a material decline in goods consumption, meaning little relief from supply chain bottlenecks. And most crucially, labor supply did not rise as anticipated to meet service sector demand. And this led to a noticeable pickup in labor costs and services inflation. Given that services are a significant portion of the consumption basket, inflation became very broad-based. With broad-based wage and price pressures by late 2021, it was increasingly clear that elevated inflation would be more persistent than initially thought, and policymakers therefore began the process of removing monetary accommodation, intending to slow economic activity and bring demand into better balance with supply. In March 2022, the FOMC raised the federal funds rate by 25 basis points. Financial conditions had already started to tighten, especially in the mortgage market, in part due to the Fed's policy direction statements or forward guidance. Figure 1, which I showed before, showed that after March, policy rate increases were swift, with a 50 basis point hike in May, and then 75 basis point increases at the next 4 meetings, followed by another 50 basis point increase. And by the end of 2022, the FOMC had raised rates cumulatively by 425 basis points, a very rapid pace relative to other tightening cycles since the Volcker disinflation 40 years ago. Policymakers judged that high, unexpected, persistent inflation, combined with a tight labor market, required policy rate adjustments to fulfill the Fed's mandate. And rates were increased an additional 25 basis points at each of the next 3 meetings to over 5% in May of this year. I will note that high inflation takes a toll on all of us. In my travels around New England, and it's been a pleasure to visit all of the states in our 1st district, I've heard repeatedly about the challenges that households face from rapid price increases, particularly those with lower incomes struggling to make ends meet. Inflation is challenging as well for businesses that are forced to grapple with higher costs and with more complex planning and investment decisions. So this battle against inflation was and is important, and it's in the public interest. Uncertainty also played an important role in policy setting as the Fed sought to combat high inflation. By late 2021 and early 2022, the source of uncertainty had actually shifted from implications of the public health situation to uncertainty about key economic relationships, most notably the inflation process. In particular, persistently high levels of inflation led to concerns about a possible rise in longer-term inflation expectations. If this had occurred, it would likely have made it quite a bit more difficult for policymakers to restore price stability. And as I mentioned earlier, this type of uncertainty calls for policy to move aggressively. The focus on bringing inflation down and containing longer-run inflation expectations also created additional uncertainty about the economy's ability to withstand such a rapid tightening of financial conditions. And the banking stresses caused by the collapse of Silicon Valley Bank and Signature Bank in early March 2023 added to this concern. Many expected that the banking turmoil might restrict consumer and business credit beyond the typical impact of policy tightening. Even though many forecasters have expected a slowdown this year, demand has remained remarkably resilient to date. And indeed, since the beginning of this tightening cycle, the economy has remained in a relatively strong position. Household balance sheets have been solid, partially because of the savings that were accumulated in the early stages of the pandemic. And corporate cash holdings have been elevated, partly because firms had been able to lock in financing at low rates earlier. These factors have likely made the economy less interest sensitive than it has been in past tightening cycles. More recently, however, there's evidence that firms' cash holdings are declining and that household stock of accumulated excess savings are diminishing, and these developments will raise the need for credit and eventually make demand more responsive to high interest rates. So with interest rates firmly in a range that will restrict the economy, we are starting to see promising signs of policy having the desired effects. In particular, the darker line in Figure 9 shows the total PCE inflation. This one does include volatile food and energy prices. It shows that that is down considerably from its peak. The core inflation, which is the lighter line, has also moderated some, but it has some way to go to return to 2%, and so it's really too soon to tell whether the recent progress will be sustained. Disaggregating core PCE inflation into its 3 main components, as shown in Figure 2, provides some valuable insight into the different drivers of inflation. Inflation for goods, which is the dark blue line, has decreased noticeably with the improvement in supply conditions. And as lower market rents are starting to pass through, housing or shelter inflation, which is the lighter blue line, is moderating as well. And I would certainly expect that to continue. But core inflation for non-housing services, the orange line, remains elevated, and this component accounts for over half of core consumption. Bringing this component down will likely require labor market conditions to cool somewhat more, since labor represents a large share of costs in the services sector. While the unemployment rate remains near historic lows, there is some evidence of demand becoming better aligned with supply in the labor market. For instance, Figure 11 shows growth in payroll employment, although still above trend. And despite a jump in September, payroll growth this year has clearly slowed relative to last year. And the previously very high voluntary quit rate has fallen to pre-pandemic levels. Lower, though still high, job vacancies are also consistent with gradually cooling labor market. Figure 11 also shows that we're seeing some promising labor supply developments as well. Labor force participation has increased, especially for prime age workers who are those aged 25 to 54. In this context, the FOMC has shifted to a new, more gradual policymaking phase this summer, holding rates constant in June and again in September after a 25 basis point hike in July. In my view, this transition to a more patient approach, taking the time to holistically assess incoming information, was warranted for a number of reasons. In particular, it reflects the fact that we're likely very near and perhaps at the peak for this tightening cycle, with the risk of inflation remaining persistently high more closely balanced with the risk of slowing activity more than needed to achieve price stability. Once again, appropriate policy in this phase is importantly influenced by uncertainty and the related risk assessments. With inflation expectations well anchored, and the uncertainty now relates more to difficulty assessing the ultimate impact of our policy actions to date and to extracting signal from data that are noisier than usual. In reviewing the incoming economic data, I avoid focusing on individual data reports, looking instead for trends that show both sustained reductions in inflation and progress on the underlying goal of realigning supply and demand. Patience will give us time to better separate that signal from the noise in the data and also to balance risks as the effects of tighter policy continue to work their way through the economy. I do expect that we will need to hold rates at restrictive levels for some time until we see evidence that inflation is on a sustained path back down to the 2% target. And while, as I said, we are likely very near and perhaps at the peak for policy rates, further tightening could be warranted depending on incoming information. Overall, I continue to be realistic about the economic uncertainties and the risks, but optimistic that price stability can be restored with an orderly slowdown in activity and only a modest increase in the unemployment rate, an outcome that is consistent with both parts of the Fed's dual mandate. So looking ahead, there'll be many important policy-relevant issues to be studied from the still evolving business cycle induced by the pandemic. That said, I hope to have conveyed the important role for uncertainty considerations in setting monetary policy. There are, as I've noted, different types of uncertainty, and depending on the type as well as the context, uncertainty may call for policy to move unusually rapidly or to take a more wait-and-see approach. And in the current policy tightening cycle, this has contributed to the different policy phases I discussed, with a period of aggressive moves followed by the current more gradual approach to policy. The pandemic represented uncharted territory for policymakers, and risk assessments, however difficult to make, had to be made. One lesson that I'll offer, with the benefit of hindsight, relates to risks from supply shocks. In particular, the risk of a widespread binding supply set of constraints may suggest a stronger case than previously realized for ensuring against too high inflation by removing policy accommodation more quickly. More generally, I look forward to the extensive research and debate to come as we endeavor to draw additional lessons, deepen understanding, and improve policy. Still, the evolving uncertainties about the economy Despite the evolving uncertainties about the economy and appropriate policy, I hope that you, like me, are encouraged by the economy's resilience and the progress on inflation to date. So I've shared quite a lot with you today, including about the need for reflection, learning, and humility for policymakers, especially in extraordinary times. The backdrop has been uncertainty. That's going to remain. It's a fact of life, and it's going to be elevated at times. And so in this context, I'd like to end by offering some concluding thoughts from my own career journey, and I hope you find them helpful. First, lifelong learning, I think, is essential for individuals and for institutions. I see this as more than an activity, it's a mindset. And in an uncertain, evolving world, drawing lessons from past experiences will help us do better and improve outcomes. Developing new skills and expanding knowledge positions us for future opportunities. And I hope you also agree, it's just great fun. For me, learning is really one of life's joys. Second, seeking out thoughtful, capable people with diverse perspectives, including those you may disagree with, is a valuable practice for policymaking, also for work and in life. Listen well so that you can learn. Hopefully, you'll also develop strong partners and collaborators who can assist and support you in navigating uncertain contexts. And I encourage you to share your own perspectives. Smart, capable, Wellesley women have an awful lot to contribute, and so please share your perspectives. A third related point is the importance of gathering information broadly. This deepens understandings and can help moderate uncertainty. By information, I mean both quantitative data, which is core to empirical economics, and also qualitative information, such as from case studies and narratives. I'm excited to see technology leading to new data sets that we can parse for insights. And I also see intentionally hearing from a wide range of stakeholders as complementary to the collection and analysis of statistical data, including hearing from voices that have not traditionally been in the room. That brings me to where we started, which is economics. It's a field that does open doors, though there is important work for those of us who are in this field to ensure that economics itself is open and inclusive. For me, it's a discipline that intrigued me as a teen, and it's been a great foundation for a decades-long, still unfolding, varied, and I have found fascinating professional career. Time and again, I valued the structured approach that economics brings to analyzing complex contexts and drawing inference from data sets. Its frameworks are extremely useful for making decisions under uncertainty. And so I congratulate and hope to encourage, maybe even inspire a bit, those of you who are studying and teaching economics. So thank you for having me here to discuss this period of extraordinary uncertainty and the challenges that were ushered in by the COVID-19 pandemic and implications for monetary policy. Of course, uncertainty really is everywhere. It really is a fact of life. Learning, data, frameworks, and flexibility can help us address it, and they can also enrich our lives professionally and personally. So it's been a pleasure to share my views with you. I wish each of you all the very best. Thank you very much, and I look forward to questions.
Thank you so much, President Collins. I just wanted to draw everyone's attention to the fact that there's 2 microphones. I think we have about 10 minutes for questions. We would really welcome questions from audience members, especially students. So please step up to the mic if you have a question.
Please.
Okay, so you talked about unexpected events leading to a great period of uncertainty, and I'd say the recent war in Israel would be one of them. What kind of economic impact do you see happening in the United States, and does the Fed have any policies in mind to mitigate those economic damages?
So we certainly pay attention to a variety of things that impact the global economy, and we'll certainly be taking a look to see whether there are particular impacts. Given the size of the U.S. economy, there are a number of things that have a significant impact in other countries that don't have as large an effect directly on our economy. Many of the impacts of the horrific events and what we're seeing at the moment are beyond the economic ones, of course. But certainly as part of our broader models, as we look through what the dynamics look like, it's certainly something that we will continue to factor in.
Hi, I'm Sarah Johnson, Wellesley class of 1973. Historically, monetary policy has affected economic activity with long and variable lags. Do you have any observations in the current situation, whether the speed and nature of transition of monetary policy has changed?
Sure, and there's actually a lot of discussion about that. And I think that there is a bit of a nuanced answer, and the data, of course, are still unfolding. So some things happened quite quickly. So if you look at the transmission to mortgage markets, the anticipation that the federal funds rate would be increased was enough to start increasing mortgage rates. And so the context and the expectation of policy changes, so that transmission happened arguably somewhat faster than might have been anticipated. But then there are reasons why some of the impact more broadly through the economy seem to be taking longer. And of course, time will tell when we look back on the data to actually parse through all of the different effects. So I had mentioned that there are, were excess savings households accumulated in part related to the fiscal support during the pandemic. Some of that meant that households had a lot of resilience in savings across different income levels, and so it's taking longer for some of the tightening to have an impact. And the same thing for firms as well, because interest rates were so low that lots of firms refinanced and locked in low rates, and so don't have to go to credit markets and are able to follow through on investment and other decisions without that connection. And so there are reasons why in some ways it might have gone faster, but then there are also reasons that it might be slower in other dimensions. And figuring out what that balance looks like is the subject of a lot of debate and quite a lot of work. I think it's both, and it's still unfolding. In my view, I don't think that we have seen all of the effects of the policy increases to date go through the economy, which is one of the reasons I think in this phase, a kind of gradual, really holistic data assessment approach is what makes the most sense.
Thank you so much, Susan, and just congratulations. It's so wonderful to see you in this leading role, and again, thank you for being here. As you look back on the pandemic and what we learned, and as you look at that unpredictable time, we're bound to have another one. And is there anything that you've learned and anything that we've learned as a nation as we think about supply chain, as we think about workforce, et cetera, that if we were to experience another pandemic, hopefully handled better, that we would learn as we think about what we've been through?
So I think that's a great question, and it's also a really important and complicated one. So I do think that our understanding of the challenges and the length of time it may take significant supply chain disruption to unwind, I think we've learned quite a bit about that. We also, so if you went back some years, it wouldn't be a standard piece of data that was presented as part of the FOMC briefings to be looking at what's happening with supply chains and how are we thinking about that, right? So we've expanded the range of information that we look at when we're trying to see how's the economy doing, what trends are happening, are there surprises, what things are working in what way. So I do think that one takeaway has been to look more broadly at different aspects of the economy, and that's something that we'll continue to do. And again, I think the global, as an international economist, the global linkages that played a key role here on the supply side, I think there are clearly lessons there. One of the challenges is for that third category of uncertain things, the unforeseen events, each one is so different that there's also a bit of a risk potentially to leaning too far into the last one where the new one might actually be very different. So I think there's a lot to learn and really welcome that. I think we will, as I said, there'll be lots of work and lots of study and lots of debate about what could have been done differently. How do we think about that? I do think one of the lasting things is likely to be some of the expansion in the kinds of data that we look at, and I think that that's a good thing. A line, that's great. Oh, and I'll alternate, yeah. So you'll be next.
sorry. So I'm like a prospective education econ major. So I was really interested in the figure that was talking about unemployment and educational attainment, and was wondering, like, we know there's policies about helping people get like their bachelor's degree with student aid and loans, but like what policies are being made to make it more equitable for people choosing a different alternative educational path, like going to technical school or just not going to college at all, to make it more equitable for them to get jobs?
Yeah, so let me say a couple of things about that. And part of it comes from having been an educator in higher education for most of my career. It's something that I care deeply about and I'm really passionate about. So, if you look at the Fed's, I think our overarching mission is a vibrant, inclusive economy that works for everybody. Opportunities for everyone to be able to participate is part of that vibrancy. And there's not one pathway, there are lots of different pathways. And I mentioned briefly in my talk with one of the charts the extent to which there are disparities of access and opportunity. And I think you alluded to that to some degree in your question. So the Fed's focus, as I said, is really monetary policy. One of the things that we do is nonpartisan, hopefully very thoughtful research to better understand a range of things. And we do a lot of work on labor markets and share that work and help to inform. And we also care deeply about about our workforce. And so understanding opportunities for increasing skill and support. And that's everything from wonderful institutions like Wellesley, community colleges, which educate more than half of those who go on beyond high school. So all of that, and really drawing attention to the role that those institutions play, and continuing to work with them in part as community partners as we think about how to foster a vibrant, dynamic economy. One other thing I'll just mention briefly, in some of our community development work, and a lot of people don't know that the Fed actually does that kind of work. One of the initiatives that has, I think, been quite impactful is an initiative called Working Places, and what that does is build on research that showed that collaborative initiatives from local leaders working together to identify in a rural area that might be struggling economically or a small city that might be struggling economically, something that is one of the impediments, and developing a set of strategies to try to address it. We have 30 sites across 5 New England states that take that approach to try to support a vibrant, inclusive economy in those areas. And a number of those initiatives, those sites, have actually focused on supporting educational pipelines and workforce development. So there's a range of things that we can do. And again, a lot of the more direct things that work in that space would really be more fiscal policy. But it's an absolutely important dimension of what we do, and there are ways that we work to support expanding opportunities and strengthening and enhancing our workforce.
Hi, thank you so much for coming, but I had a question related to the fiscal policy that you were just talking about. How closely do you work with the fiscal side, and when is it necessary to work with them, and what is the dynamic like?
So what I would say about that is that, certainly it's important to understand the fiscal context for the monetary policy work that we do, but elected leaders, so Congress and the legislative branch, are really the ones that are charged with fiscal policy, and so I don't comment explicitly on what is appropriate fiscal policy or not, and that kind of thing, but there certainly are a lot of connections, and there are many of the people who do research and work in the Boston Fed and in other parts of the Federal Reserve System who are experts on fiscal policy and might work closely with colleagues who are in some of the fiscal agencies. So there's all kinds of different connections and ties. Thank you.
Hello. Actually, I was a bit more curious about how you came to be in economics in the first place, how you became drawn to monetary policy, and why, and not different types of economic policy, and how has your experience as a woman of color in economics shaped your outlook in deciding things? Yeah,
so that's a big question and a good one. So thank you. Let me say a few things about that. As I said in my talk, for me, the background in economics has really been a just wonderful kind of foundation for doing work that I find important, rewarding, satisfying, and fascinating. At the same time, it's still too often that I'm in an environment where I am the only one or one of the only ones, and that might be true because I'm a woman, it might be true because I'm a person of color, or both. And I see it as being really important not just to find ways to open doors, but to make sure we're holding them open so that we can expand the opportunities for all. I do think the kinds of questions that people ask when they're doing research, for example, can be influenced by their own backgrounds and their own experiences. And so not having everyone at the table for economics and also for having a vibrant economy, I think shortchanges us. And I think it's important to recognize that and to do what we can do to work together to really open doors and to hold them open, and also to recognize the valuable impact of different perspectives. I think sometimes people make assumptions that folks in particular roles look a certain way, and I think we need to work harder to recognize that you don't judge books by their cover, and that our job should be to support, especially in educational settings, and I think in the field of economics, to really embrace and welcome a range of perspectives and the great work that people who might bring different backgrounds can do. So I think it's important to keep talking about this. I will say that there's work that the American Economic Association has been doing for some time, and that's helpful. And a lot of economics departments are doing work in this space as well. I think we need to work together to make good progress. And I've appreciated some of the very good work that I've seen.
Through this period of higher inflation, the labor market has proven more resilient than originally expected. I'm curious if you would consider this grounds to justify redefining price stability as something higher than 2% as a part of the Fed's longer-term outlook. Thank you.
So let me say a couple of things about that. And again, I have to say, really a great list of questions, so much appreciated. The Federal Reserve has a review of what's called its framework that happens roughly every 5 years. And so there will be a new review in the coming years to take a look at what the right, whether it makes sense to consider changes in that framework or not. I will say that if we're in the middle of battling inflation as we are right now, to me, that's not a time when you change the goalposts. And so from my perspective, one of the most important things the Fed has is the credibility that it invests in over time. And I think it's important that, having made it very clear that our goal and our target is 2%, that we follow through on that commitment for a variety of different reasons. And again, I continue to be realistically optimistic that we will be able to bring inflation down in a reasonable amount of time without a significant slowdown, some slowdown perhaps, and without a really large impact on labor markets. But I think these are important questions to have, and or questions to raise, and important things to discuss.
Thank you all for your great questions and your attention. And once again, let's thank you.
Thank you very much.